Good. Okay.
Thank you.
Bye. Good evening and a warm welcome to all our delegates that have already logged in. I'm Roshni Magan from ShipDev Training Academy, and we once again bring you an interesting CPD accredited event that will be presented to us by Prof. Garach. For all our medical professionals, should you wish to acquire your CPD point, please remember there is a cost of $150, and it's crucial that you actually complete our feedback form. The link to complete the feedback form will be presented in the chat box. Please click on the link and complete it, because that is our evidence that you've attended, and we can then submit it to HPCSA for an upload of your CPD point. On the same token, as we know today, our national soccer team is playing the semi-finals. So we wish our team Bafana Bafana all the best and hope they come back victorious. With that said, we're going to give our other delegates a few minutes, and then I'm going to hand over to Prof. Garach to start his discussion. Prof, can we give our delegates maybe a couple of minutes just to sign in?
Yeah, good evening, Roshni. Yeah, thank you. I think we can give them perhaps another 3 or 4 minutes before we make a start.
Excellent. Okay, so in the interim, I'm just going to share one of my screens, and then I'll hand over to you. I will now hand you over to Prof. Garach. Prof, would you like to start? And the rest of them can then join in as they log in.
Come along. That's fine. Okay, so we're going to try and make a start. Good evening, ladies and gentlemen. Let's talk. Your tax, your wealth. An introduction. I am Professor Garach. My profile. I am the CEO of Garach Corporation, a financial and fiduciary consulting practice comprising chartered accountants, lawyers, tax consultants, and certified financial planners, all under one roof. I am a chartered accountant and a certified financial planner. I have held professorial positions at various universities. I was the South African Financial Planner of the Year in 2004. I have served as director on government and commercial boards. I am a financial coach to high net worth families. The content of my presentation, and before I start discussing the content, perhaps let's us pause for a few minutes and just chat about how this seminar came about and how we allowed it to be made much broader in terms of the content. Now, CPD Academy, as you may know, is an academic learning institute, and what they actually do is put together seminars, and this particular seminar is meant for medical doctors who are requiring continuing professional development, which is commonly known as CPD, for the purposes of meeting the requirements as far as the Health Professional Council is concerned. So the seminar is designed primarily for doctors. However, we made the seminar much broader, and we allowed others to come in. So only if you can be a medical doctor and you're looking towards getting CPD points, then what would happen is that you would have registered for this particular seminar, and then you would be required to pay in 150 Rand to actually join. However, there are other people who are listening to the seminar. They're not looking towards getting any kind of CPD points, but certainly the way the seminar has been designed, it is meant for the medical profession. It's meant for other professionals. It's also meant for business people. It's meant for people who are employed. So you can see it's a very generic kind of seminar, not particularly targeted for the doctors, but you'll see the underlying theme relates to doctors. So therefore, the content is on that basis. So if I go through the content, it's about taxing times are here, tax planning to avoid tax, asset structuring and trust, wills and estates, private wealth management, the South African grey listing by the Financial Action Task Force, commonly known as the FATF, and management tips for a medical practice.
Excuse me, I'm sorry to trouble you again. There's been a bit of a mix-up. My wife brought me here at 9 o'clock and to see the eye specialist, and we went away about an hour ago, didn't we? And then we did a bit of shopping and went home. And now, you know, I think he's given me the wrong glasses.
Oh, what makes you think that?
Well, this isn't my wife, you see.
Well, you can see from that medical doctors, professional negligence, medical negligence is quite critical to them. They get an ethical point for that. And clearly here, we're not sure whether that is medical negligence or not. But just moving on to more serious matter, and it doesn't apply only to doctors, but it applies to everybody. There's no doubt that taxing times are here, and this doesn't give you the leverage now to say, I'm paying too much of tax, so how can I hide my income so it doesn't really become known to the South African Revenue Service? The South African Revenue Service, you may have known over the years, have changed the way they do business. And certainly from their perspective, they treat it like a business. And you'll see just now, as I start chatting about the South African Revenue Service and paying taxes, they're certainly in business with you. So whatever you are doing, they would love to have a slice of what you are getting. So taxing times are here. And how do we know this? Certainly, you may have saw the Commissioner of the South African Revenue Service on various platforms. So whether it's in the press, or whether it's on TV, or whether it's at conferences, he's made it known that it's difficult. Times are here now. We're certainly looking towards collecting more taxes. And based on that, we're going to get you to pay more. So we're going to be looking at your affairs in much closer detail. So whether you're in practice as a doctor, whether you're in practice as any other professional person, be it a lawyer or a quantity surveyor or an architect or an engineer, you have to, or you could be in business, or you could even be having to fill in tax returns based on the salary that you're receiving. You may have to prepare sometime a set of financial statements. So why do you have to prepare financial statements? You may have to prepare financial statements for the bank. And why for the bank? That may be because you borrowed money from the bank, or it could be because for some reason, you have to furnish these financial statements to the bank for other reasons. It could be an overdraft, it could be a loan, it could be because you enjoyed some kind of funding in the form of a lease or a hire purchase. So they'll be looking for information from you. The other person who would be very interested in the financial statements that you draw up would obviously be South African Revenue Service. The South African Revenue Service will be looking towards you completing financial statements. So that's the reason for us preparing financial statements. However, it's important for you to understand that you have to have a good accountant, what we call a good tax accountant, to prepare your financial statements. Because remember, as I indicated to you, the South African Revenue Service is a partner in your practice. Now, why do I say that? Because you have to pay taxes. And remember, if you are in practice and if your income, your taxable income exceeds 1.8 million rands, the South African Revenue Service will be collecting 45 cents in every rand that you earn. So you can clearly see they have like more or less a 50% stake in your business. And therefore, they're very keen on knowing how you run your affairs, what you do in your business, exactly, so that they can get their fair slice of the tax that is due to them. And therefore, they become partners in your business. So you're looking for an accountant who is savvy from a tax perspective. He must have strong tax expertise. He must be conversant with the new tax laws. Now, you can't get an ordinary accountant, a bookkeeper, to handle your tax affairs if he is not brought up to date with all the new tax laws. And why do I say that? Because if you underpay your taxes in any particular tax year, there's quite a heavy penalty that you end up having to pay. So what am I alluding to? If your taxable income exceeds 1 million rand in any particular tax year, we're talking taxable income, we're not talking turnover, we're talking turnover minus all your legitimate business expenses, arriving at what we call taxable income. And if that exceeds 1 million rand a year, then reasonably you have to pay almost all your taxes by the 28th of February for that particular tax year. So let me give you an example. Let us say that your taxable income for the tax year, which is going to end in 2.5 weeks' time, equals, let's say, 1.5 million rands, which means that by the 28th of February 2024, you should have paid at least 90% of that tax in that particular tax year. You may say that that's very unfair because I don't even know what my profit is going to be or what my taxable income is going to be at the 28th of February. Now, that's a very unfortunate scenario. We, as tax advisors, tried to argue this with SARS, but they were having nothing of it. They wanted to make sure that people were reasonably bringing their tax affairs up to date. So let us assume that your taxable income happened to be 1.5 million, and you actually only paid taxes on 1 million rand. So what you've done is that you've underpaid taxes on the 500,000 rand. So you're going to work out what the tax is on that. And effectively, let us assume that the actual tax came to 500,000 Rand, you will end up having to pay an understatement penalty for underpaying your tax on the 500,000 Rand. So immediately you will have to pay 20% of the 500,000 Rand on the 1st of March. That will have been levied to you of 2024 of 100,000 Rand. Now, many of you are not aware of this because you don't study your assessment. You accept whatever your accountant tells you and you accept that figure. So remember, you've short paid your taxes and you will end up paying 100,000 Rand just in the form of what they call an understatement penalty for underpaying your tax. In addition to that, you'll pay interest to the fiscus because in effect, you should have paid the tax, so the money should have been in their account rather than yours. And they will charge you interest at what we call the SARS rate. The SARS rate is repo, which is the Reserve Bank rate, plus 1%. So they will charge you that interest. In addition, until such time you paid that under amount in terms of the taxes that were due. Now, in addition to that, I often find that clients will come to me and say to me, hey, please do me a favor. Can't you do something for me? You know, I did underpay the tax. Can't you make a plan? Now, really speaking, that's extremely difficult, especially the way the SARS operate now. Because if they catch you, then the omitted income, the tax thereon, a penalty of 200% will be levied on that. And then you'll bitterly regret for not paying. So how do I make a plan? So you're really telling me, why don't you reduce my turnover? Or why don't you inflate some of my expenses? Now, clearly, as an accountant, I can't really do that. And you're invariably going to end up having to get caught out, and you may have this omitted penalty, income penalty, up to 200% that could be levied to you. So therefore, it's very important that you find yourself a good tax accountant who can do your work properly and who fully understands the law. Now, it's all not about Peanuts writing to the receiver of revenue. And as you can see, Peanuts is busy typing here and he's saying, I am writing to you, SARS, to cancel my subscription. Please remove my name from your mailing list. I can assure you that they are after you. SARS will catch you. So how can they catch you? Clearly, SARS has a tie-up. Now, this tie-up has been going on for the past 15 years, where they are linked to the various institutions, and they, in fact, get information from all of these institutions. Now, who are these institutions? And you can see the tie-up is with banks. So in other words, as far as your bank balances are concerned, as far as your bank accounts are concerned, they are aware that you have these bank accounts, and they can dig into your bank account very easily by contacting the banks directly without you even knowing, and in effect, get the information. So they have a tie-up with the banks. They have a tie-up with other financial institutions like unit trust companies and so on. They also have a tie-up with the deeds office. The deeds office registers properties in your name or in the name of the company in which you could be a director. And through your ID number, they would easily be able to link and find out all the properties that are registered either in your name or in the name of the company. They also have a link with CIPC, or commonly known as CIPRO, which is a company registration and CC registration office. And they would then pick up, based on your ID, all the companies in which you are a director, all the companies in which you have a member's interest in the form of a CC. And now, with this new anti-money laundering law and the fact that we have all kinds of new laws, which I will discuss later, the beneficial shareholder will also have to be disclosed in companies. So they will get to know exactly where you are a shareholder in the various companies. Previously, they were unable to tie the shareholder company part is concerned, but now going forward, they most definitely can do that. They will also have a tie-up with the e-Natus records where you have cars registered in your name. So whether it's a Porsche or whether it's an ordinary little car that you are driving, they will have that information available and they can dig into that information just with a copy of your ID. They also have access through your ID with the various insurance companies and also with other institutions. Now, this is something that they've been doing for a very long time. They've been trying to tie up, as far as doctors are concerned, with the medical aid companies. So when a medical aid pays you an amount as a medical doctor, that will get recorded. And that information SARS have been trying to get hold of electronically. So if they get that information to say Dr. X was paid for the year 1 March 2023 to 28th of February 2024, he was paid 600,000 Rand by X medical aid. You would find that that information should flow directly into the SARS computer box and automatically through your ID be linked to you as a taxpayer. They can total medical aid X, Y, and Z, paid you in total 5 million Rand, and automatically the computer should go and look into your tax return, look at your financial statements, which is already loaded by your accountant, to say that your turnover for the year was 3 million. So immediately that raises a red flag for them, and they would see the discrepancy. You're going to be subject to audit. So you can see that that kind of information they get quite easily, and SARS will catch you. And if they catch you, they hit you with a heavy penalty. So I think from a tax evasion point of view, that is where you're using illegal means to avoid paying tax. You don't want to be there. And therefore, it's very important that you have your tax affairs in order. So taxing times are here. The taxing analysis, tax evaders beware. So we're talking about people who are trying to use illegal means by trying not to pay the full amount of tax. So those are falsifying books, understating your turnover, inflating your expenses, not showing companies' incomes, or not showing wholly companies depositing monies into your bond account, your private bank account. For example, it could be medical aid amounts, etc. For those people, they are all tax evaders. And if SARS gets to know that you are tax evading, they immediately write to you and ask you to fill in a lifestyle questionnaire. Now, the lifestyle questionnaire is a pretty lengthy document. And unfortunately, you'll never come out of getting away completing that particular questionnaire. But what it actually does, it tries to match your income with your lifestyle expenses and the growth in assets. So the income that you are showing them against what this lifestyle questionnaire does establishes what all your lifestyle expenses are. How many holidays, overseas holidays you go for, how much of insurance you're paying on a monthly basis. They ask you all of those questions. And they then total your expenses, then compare it with the income that you have shown them, and then establish what were the growth in your assets from 1 year to the next at cost. And immediately you'll see what they call apparent discrepancies or unaccounted for income, and they will catch you red-handed and effectively then nab you with a penalty. So what is this understatement penalty all about? Now, the understatement penalty all along used to be a highly subjective matter, but that subjective matter has now been put to rest. And what they do is that they get you in terms of your taxpayer behavior, of what you've done, what wrong you've done, and then impose a penalty based on that. Now, that penalty can vary from 0% to 200%. And what they do is that they look at your taxpayer behavior. So if you look on the left-hand side of this table, which they've designed as part of the Tax Administration Act, you can see it talks about behavior, which is taxpayer behavior. So the black, and then we go into the gray part down the line. It says substantial understatement of the taxes by the taxpayer, reasonable care not taken by the taxpayer in completing his tax return, no reasonable grounds for the tax position, gross negligence on the part of the taxpayer, intentional tax evasion. So those are the different classes of behavior shown by the taxpayer. So now if we go on towards the right and we go to the brown area, it says in the various columns, a standard case. It talks about an obstructive or a repeated case or a repeat case. It talks about voluntary disclosure after an audit notification. And then the fourth column talks about a voluntary disclosure before an audit notification. And you can see that the penalty will range from 0% to 200%. So that's your range of the penalty that they can apply. Now, they apply this particular table in terms of the Tax Administration Act very rigidly. So if they catch you and there's tax evasion, you're in serious trouble. So let's just follow what this table really is telling us. So let's say if you, for example, omitted to declare what some turnover from a medical aid that you received for 200,000 Rand. And then you realize we are in 2024 now, but you realize that in 2020 tax year, during COVID, you forgot to disclose it. So you go forward and then you advise SARS that you haven't disclosed that amount to them and you would like to now disclose it and pay the tax on it. So that's what we call a voluntary disclosure before an audit notification that is sent to you by SARS. So then and if you set out the facts and it's the first time offense and so on, they may decide to impose a 0% penalty. They will tell you, okay, you now disclose that income to us, the 200,000 Rand, you pay your tax on that amount. And however, we're going to charge you interest because we should have received this money in 2020. It should have been in our bank account rather than yours. You would have earned interest on it. And based on that, whatever is the shortfall from 2020, from an interest perspective, you need to pay. In other words, you pay the tax plus you pay the interest. But now let's take it to the other extreme, where, for example, there was intentional tax evasion and they catch you. And it is obstructive and it is repeated on a couple of occasions where they've caught you out before as well. Then they will not feel shy to give you a 200% penalty. And you can plead as much as you want to. They are pretty rigid about these things. And unfortunately, if they hit you with a 200% penalty, they will not change and they will charge you the 200% penalty. Now, in between the 0% and the 200%, you can see there is a range. So you could end up where there could be, for example, a voluntary disclosure after an audit notification, but it happens that it is not a substantial understatement. It could be a very small amount. Then they will levy a penalty of 5%. But if they find that, looking at that same example, if there's intentional tax evasion and voluntary disclosure after an audit notification, because it could be the first time, then they could hit you with a 75% penalty. So you can see that this particular table is part of the Tax Administration Act, is taxpayer behavior, and it's very unfortunate that they rigidly apply this, and you have to really fight it. Again, you need a very strong tax consultant to be able to fight SARS on the penalties that they're imposing on you. But having said that, I must admit that SARS does have a heart. It is possible to compromise a SARS debt with SARS. So you could have a debt owing in the form of taxes to SARS, and the real question is, will they compromise that debt? So you could be owing 10 million Rand, and you come forward and you say to them, look, I can't pay 10 million Rand, but let's compromise. I'm quite happy to pay you 6 million Rand. Now, SARS will compromise, provided you get a good tax consultant, he motivates well for you, and you have a good cause. Now, why would SARS want to compromise a debt? They will want to compromise the debt, as I indicated to you earlier. Remember that SARS is a partner in your business. And therefore, he wouldn't want to see you stone dead. He wouldn't want to see you close your business down. From an economic point of view, he wouldn't want you to fire 100 people that are employed by your business and so on. So therefore, on that basis, they're quite happy to look at perhaps compromising with you, as long as it's reasonable, you're well motivated, you have good cause in believing that you want to compromise your debt because you want to stay in business, you want to employ the people, you want to continue to pay your taxes, you want to continue for them to remain as a partner in your business. Excuse me. So that's what you're trying to do. This is what Albert Einstein had to say about tax. The hardest thing in the world to understand is income tax, or just tax in general. Now, why do we say that? If you look at tax, today it's one thing, tomorrow it's something else, the next day it's something else. So clearly, why do we say that tax keeps on changing? The reason for that is that the way tax is interpreted, firstly, by yourself and your tax consultant and your tax accountant, versus what SARS believes the interpretation of a particular law is. Within SARS offices, the Johannesburg office may interpret something different from the Durban office, from the Cape Town office. That's the second problem. It could be, for example, income tax law, which could change, which could be passed today, which could change the way the law is being interpreted, and that may take some time before they change the law itself. And SARS is very quick when loopholes are picked up and taxpayers get away with something, for them to quickly change the law so that they block the loophole. So these are the various things that happen all the time. And therefore, there's no doubt that tax is very difficult to understand, both from a SARS perspective, as well as from a taxpayer and your advisor, your tax consultant's perspective. So we're always at loggerheads with SARS. Having said that, there are obviously many ways of tax planning. Now, tax planning is different from not planning at all your tax affairs. So you get tax planning, which forms part of tax avoidance, which you are tax planning to avoid tax. So the word avoid means that you're using legal and legitimate ways of saving taxes, and there's nothing wrong in doing that. So you're following the rules, you're following the law, the tax law, and you're just getting smart people to arrange your affairs in a way that you pay the least amount of tax. And you'll see in my presentation, there's so many ways that you can adopt to make sure that you are smart and that you are paying the least amount of tax. So that's what tax planning is all about. We don't want to go down the route of tax evasion, because that will land you, unfortunately, in jail, and you don't want to go there. You may have read recently, as I indicated, SARS is getting really tough. And recently you may have read about a lot of tax cases in the criminal court where SARS are taking people based on tax evasion, where they're stealing VAT, they're stealing PAYE, they are regarded as tax evaders, and effectively they're getting a jail sentence, including the accountants. So you find that your accountant sometimes would say, okay, don't worry, we can make a plan. Don't ever follow that route, because you could land up in jail at the end of the day. Because remember, you are signing the tax return. It is your tax return, and therefore you could end up with problems. So having said that, I'm not here to tell you how to pay no taxes. The hard facts are we all have to pay taxes. We all have to contribute to the fiscus. We all have to contribute to the government to make sure that we can uplift the lives of all the people in South Africa. And I think that's very important. Now, I know what's running through your minds. There is such a thing as tax morality. I pay tax in this country. What do I get in return? I have to provide for my own security. I don't get any tax deduction for that. Provide for my own children's education. I have to provide with after-tax money. I have to provide for my own retirement. If I want to get to hospital, I have to get a medical aid. Yes, I agree with all of that. Now, that's a different political debate. I agree, you have the vote. You must go and vote these guys out. That's your job. And that's something that you need to think about very carefully before you put your cross the next time this year in April. So make sure you make the right decision. So having said that, there are tax planning techniques that are available for you to avoid paying tax. And here are some of the ones. I have to personalize it to each individual. So these are 4 generic ones that can apply to everybody. So depending upon where you stand in your personal situation, these things may apply, and you could then obviously use it to your advantage. And as I indicated, there are many other ones. You need to consult with my office personally and set out your personal circumstances, and we can show you many other ways in which you can avoid tax just by tax planning. So let's look. The 4 that are pointed out here is splitting your income, and in that way paying less tax, The second one, receiving a salary versus investing in assets. And rich people do this, or wealthy people do that. Using corporate entities to avoid tax. Using the solar energy investment to maximize on your deduction from a tax point of view. Again, you have to engage a tax consultant to make sure that you're not evading, but rather avoiding taxes, and that you're doing the right thing, but these are available to you. So let's come back and look at the first one. You want to split your income and pay less tax. In South Africa, we have a progressive tax system. What does that mean? That means that the higher the income that you earn for the year, the higher the rate of tax that will apply. So this means that the first 100,000 Rand of income, roughly at the present, attracts no tax. From 100,000 to roughly about 250,000 approximately, attracts tax at the rate of 18%. And then progressively, as your income increases, that tax rate of 18 continues to climb. Eventually, when you get to taxable income of 1.8 million, you hit the highest tax bracket, which is 45%, which means for every Rand that you earn above 1.8 million Rand in the form of taxable income will attract tax at 45 cents, which means that is why I'm saying to you, SARS at that level of income is half a partner in your business, and therefore they're keen to know exactly what you do in your business. So you can see clearly that because of the progressive tax system, you have this higher rate of tax. So how do you beat the system? You beat the system by splitting that income of, let's say, 2 million Rand. So I use the example again of a medical doctor, and I'm talking about, let's say, the husband. I mean, it can be the wife, but let's say the husband is a medical doctor. Okay, his wife assists him in the practice, and what she does, she takes over all the accounting, the administration, the managing of the practice, and so on. And let's say the doctor's taxable income for the year was 2 million Rand. So if he was to now pay tax on that, remember, he's going to end up paying at the rate of 45% in the Rand. So how can he now split that income so that he can then pay less tax? So what he does, he then pays his wife, in my example, a salary. So he gives her 50,000 Rands a month, which gives you 600,000 Rands for the year, so that his taxable income will then drop from 2 million Rand by the 600,000 Rand, it will drop to 1.4 million Rand. And then you'll find the actual tax that he will pay will be a lot less than paying on 2 million Rand. His wife, on the other hand, will be taxed on the 600,000 Rand, but she will start from a zero tax rate on the first 100,000, and then thereafter she will pay 18% and so on. But you'll find that if you take the sum total of husband and wife taxes, it will be a lot less than the husband showing the entire income in his hands. Also, we can take that example further. If you have university-going children who assist you in your practice, for example, they help you to make sure that your computer records are up to date. They help you to do some of the administration in the practice. You could pay them a salary of, let's say, 100,000 Rands a year, which is only 7,000 or 8,000 Rands a month. But by paying them that salary, the effect of that is that you have to open a bank account in their name, move that income into their account. And if you do that, you can then allow them to pay for their university fees from that amount. So firstly, that amount of 100,000 Rand given to them is a deduction in your practice. It's legitimate. They've been helping you with your accounting records and whatever, and you're allowed to pay them a salary. You claim that amount as a deduction, as an expense in your practice. You get a deduction for that amount. It becomes taxable in their hands, but because it's below 100,000 threshold, they pay no tax on it. They use that money and pay for the university fees, and Bob's your uncle. So what you've done, previously you were paying for the university fees from your after-tax money. So you have to earn an income, pay the tax on it, and then effectively pay for the university fees. So now you're doing it, basically claiming it. So you're doing it with pre-tax money, you're giving it to them, and they are running with it. So I would say you're beating the system, but you're doing it perfectly legitimately. There's nothing wrong in what you've done. So you can see just by cleverly doing that, how you could achieve tax saving. I'm going to talk about splitting of income in a trust. And when we get to the interviewer's trust that you could set up, you could have beneficiaries who are just born yesterday. You could have a 10-year-old, you could have a 15-year-old, you could have a 20-year-old. You could have all of these beneficiaries, provided the circumstances permit, and I will show you later in the presentation how you could cleverly, again, tax plan, use that, make them taxpayers, give them a salary, if I may effectively say, claim board and lodging from them, because you're going to put that income into their hands, into their in the trust itself will be shown as a loan account, and then you can draw out of that loan account and save for their lifestyle expenses and for their boarding and lodging in your house. You are charging them, and in that way reducing the loan account. So you can see there are a million ways in skinning a cat as long as we do things legitimately. So you're looking for best tax advice, and that's where Garach Corporation comes in. Okay. Let's go to the second one, receiving a salary versus investing in assets. Now, I just pointed out to you, getting a salary is a good thing. However, from above a certain level, there's no point in getting more income, because a lot of people argue and tell me, you know what, I'd rather go and play golf than earn more income, because for all that income, I'm earning more than 1.8 million. Half of the money is going in tax. So I don't want that income. I don't need it. I don't want it. I'd rather enjoy my life, because I believe when I give it to SARS, they're not using this money effectively to make sure that they're uplifting the people of this country. Now, I don't want to go into, again, a political debate, but it's a fair argument. That's tax morality. And I think we must look at that pretty seriously when you do your vote. Now, so what happens if you get a salary? Yes, you have to pay tax at a progressive rate. And as your income increases, you pay a higher rate. At over 1.2 million, you're paying 41 cents in the rand. So you need to look at that aspect. But what do wealthy people do? They're not interested in getting salaries. What they do is that they invest in an asset. So what would be typically an asset? An asset would be immovable property. So they invest in a, let's say, commercial building, and they'll collect rental income. So when they collect the rental income, now we're comparing apples for apples. When they get the rental income, yes, you get tax on your income, but you get tax on the income less all the expenses in relation to the property. So it could be rates, it could be cleaning, it could be a bond if you had a bond on the property, and so on. So whatever the net income is, yes, you do pay tax, income tax on a yearly basis on the net income, and that could perhaps be 6 or 7% or 8% of the value of the asset. But there will come sometime in the future where you will sell the asset. Now, when you sell the asset, you'll make what we call a capital gain. So it's a gain for tax purposes, but it's capital in nature. So when you make that capital gain, it is a difference between what you sold the property for and what the property originally cost you. So let's just take a simple example. You bought the property for 5 million, you held it for 10 years, you collected the rental income. Yes, you paid income on the net rental income on a yearly basis. You sold it for 10 million. You made a profit of 5 million rand. Now that 5 million rand will be taxed as a capital gain. That capital gain, the rate of tax that you're going to pay, the highest is again on a sliding scale, like your income tax. The capital gain tax table is also sliding, but the maximum tax you will pay is 18%. So you can see you have a difference in the rate between the 45% and the 18%. Income tax, highest rate 45%, capital gains tax 18%. That's what we call a tax arbitrage, the difference. So you can see clearly wealthy people become wealthier by investing in assets and making the gain. So that's what you should be doing. You should be taking whatever income you get at the end, investing in assets, and then basically letting the assets give you a return, and sometime in the future selling it, start to reduce your salary as much as you can, so you're not paying income tax, but you're scoring by using the capital gain. Going forward, you're paying lower amount of tax, using that for your lifestyle and all of that. So that's a good thing, and that's how wealthy people are getting wealthier in this country. The third one, using corporate entities. So again, my example now talking about an incorporated practice with a doctor. It could be for a businessman, it could be a PTY limited. If he was doing it as a sole proprietor or she was doing it sole proprietor, she could do it in the form of a corporate entity. Now, corporate entities pay tax, a flat rate of 27% for income tax, whereas as an individual, you pay up to 45, you pay 45% at the highest tax rate. So you can see there is a tax arbitrage again. The difference between the income tax rate of a company or an incorporated practice, which is 27%, against the highest rate for an individual is 45%. Obviously, you can take some income from a corporate entity and take it as a salary up to the point of 27%, and the rest you leave the profit in the corporate entity itself. And when you do that, you don't pay tax on that amount of income. It remains as part of the retained income. Yes, some may argue, but surely there's a dividend tax to pay. Yes, there will be sometime in the future when you try to reduce the retained income of the reserves and you declare it as a dividend. There's a further 27% tax, further 20% tax, and that could take you to perhaps 43 or 44%. But you don't do that. What you do with whatever you had left as reserves in the company, you then, or in the incorporated practice, you then invest that within the company. So when you do that, you're not going to pay any tax on the dividends. If you go and buy hospital shares, you go and buy company stock market shares in the name of the company, then clearly the distinct advantage there is becomes an investment of the company or the incorporated practice, and there's no need to declare a dividend. So you're not doing it in your personal name. So clearly you're now using SARS money, which you would have lost in the form of tax as a sole proprietor, using that money now to grow your asset base. That will give you more income. And over a period of time, you beat SARS to the draw in what you're trying to do. So clearly using corporate entities, it makes perfect sense. Again, it must suit your needs. Using the solar energy investment, now we know for a fact that SARS has, Eskom has really messed the grid up, and we can only blame you know who, so I'm not going to say who it is. So clearly, what the government and SARS have done is that they've decided now to allow people to privately invest in solar energy. And these investments, they've created a new section within the Income Tax Act called Section Capital 12, Capital B, which allows you to claim a full deduction against any amount that you put towards a solar energy investment. Now, there are many of these investments around. The whole idea is it's a substitute of the old Section 12J, which they've stopped. Those had limits and all of that. They had stopped. There were some flaws in that particular kind of investment. This one is clearly, there are certain rules that have come up with. Certainly, this is something that you can do, especially now when you get to this time of the tax year. You know that your taxable income is 10 million Rand. So what you could do is go and invest 10 million Rand into a solar energy investment platform, and you would then get a full deduction. The impact of that, it will reduce your income, taxable income from 12 million Rand to zero, because the Section 12B gives you no limit on the actual deduction. Again, very important to engage a tax consultant before you do any of these things, because you don't want to come short and be caught out, because you're just getting smart by using these things, but getting smart, SARS are going to look at your affairs. You can also invest in a retirement fund. Now, typically, if you're on your maximum tax bracket, you don't need not be on the maximum tax bracket, but I'm using this as an example because you can be on any level of income. So let's say you're on 1.8 million Rand of income. Then clearly, for every 100 Rand you invest in your retirement fund, what is happening for that 100 Rand, you are going to pay 55 Rand to that particular investment, and SARS is going to help you by putting in 45 Rand. Because if you don't do that investment, and if you're earning 1.9 million, then for that 100 Rand, what will happen is that you'll pay an extra tax of 45 Rand. You lose that money to the fiscus, and it's gone. On the other hand, if you decided to invest it in a retirement fund, then clearly you will qualify for the deduction, and that deduction, you'll end up paying less tax to the tune of 45 Rand. That investment will cost you 55 Rand, but immediately you're getting a credit in your retirement savings account of 100 Rand. So it's immediately giving you a return of the 45 Rand that I'm showing on this slide. Now, that may immediately entice you. Yes, it's a good thing. Well, certainly it makes sense to go into that kind of investment. But I think what is important, and this never used to happen before, you have to manage your retirement fund. So previously, they used to be very rigid, the insurance companies, and the way they had these funds, the costs on them were very high, very difficult for you to manage. You couldn't control them. Now it's a lot different. It's very flexible. You can manage your own retirement funds. And ideally, you need to meet with your financial planner once a year, have a look at the returns, see what's happening in the market, and then you could change your funds around. The whole idea is at all times with your retirement funds to be on the crest of the wave. So in other words, you want to make sure that you catch the wave in the high, then jump onto the next wave, and then move on like that. And if you do it that way, then certainly you're going to be looking for a return above inflation for retirement, say currently of inflation +5, and you can get that return so that you know when you reach your retirement age, you have sufficient capital to retire and you're not struggling, still having to work. So the formula that applies here, there is a restriction, unlike Section 12B, where in the solar investment, there's no restriction. And remember, in the solar investment, you will get a return from your investment. You will have to pay tax on it, on the income that you would earn from it. And also, when you sell your solar investment, your base cost in that case will be zero, and then the difference can attract capital gains tax. That's for the solar investment. But coming back to your retirement fund investment, the formula is 37.5% of your taxable income up to a maximum of 350,000 rands a year. That's what you can invest in a retirement fund to make sure that you're getting the maximum deduction. And if your income levels are lower, then you use this formula and establish what you can invest. Okay, so let's move on to another topic. Now, as a medical doctor, or for that matter, as a successful business person, or even being employed as an engineer or an architect or whatever you're doing, you will be amassing wealth. So you've got to make sure that the wealth that you are amassing, it is protected. And it is protected from many aspects, from many avenues. And the way you actually do it is form a trust. So you form a trust. The whole idea is to put property and your businesses and your shares on the JSE and your unit trust. So anything that's going to grow in value over a period of time, ideally should be housed in a trust for the benefit of who? It will be for the benefit of yourself, your spouse, and your children. So if you actually do that, then you are planning well within the structure of things. And if you do that, it makes your will much lighter. So what do I mean by that? Assets that are already in a trust, you don't have to address that in your will because they're not part of your estate. You don't have to pay estate duty on it. You don't have to pay capital gains tax on it. All of those good things will then apply. You just have to manage the trust and then make sure that things work out well for you. It makes your will much lighter. And if you look on the right-hand side, there's a last will and testament. And I'm sure that you don't want to be in this position. So if you read that, it's saying, I, being of unsound mind, to bequeath 40% of my estate to the taxman. Now, you don't want to be in that position, but you could very easily end up in that position if you don't plan your wealth and you don't try and avoid estate duty, 1, capital gains tax, 2, upon your death, because those are very expensive and heavy form of taxes you pay when you die. Some people say to me, well, who cares? I don't feel it when I die. Let them pay whoever has to pay. You don't want to adopt that attitude. You need to plan properly. Okay, so I spoke about a trust. So what are the real advantages of actually using a trust to your benefit? So firstly, we speak about estate pegging. So estate pegging means that you'll be saving estate duty if you put an asset in a trust. Or what do I mean by that? So if I was buying a property today, let's say in Sandton or Mshlanga or somewhere in Camps Bay, and that property is 10 million rand. I have a choice of buying it in my personal name, or because I do have the cash with me, or I could buy it in the name of a trust that I set up. Now, if I decide to buy it in the name of the trust, okay, so it means that the property will go into the trust, and let's say it's a commercial property, it'll earn you rental income, and then I'll come back to the situation about trying to distribute the net income on the property. But now it is in the trust. And then 10 years later, I die. The property value increases from 10 million to 40 million. So if I buy it in my personal name, then unfortunately I am stuck, because when I die, I have to account for all the assets that are in my personal name. And the effect of that is that all of those properties that were acquired in my personal name will form part of my estate. And I will then have to pay estate duty, and it could be as high as 30%, and it could be further capital gains tax as high as 18%. So you can see that your entire estate, almost half of it, could go in the form of debt taxes, namely estate duty and capital gains tax. So therefore, from an estate, whereas on the other hand, if that particular property was lying in the trust, you could be one of the discretionary beneficiaries of the trust, but that property doesn't belong to you. So the 40 million rand valuation placed on the property is not yours. It is a trust property. It belongs to you, your spouse, and your beneficiaries. So it's not brought into your estate. And in that way, you, your spouse, and your children will never pay estate duty on that particular property. So you can see clearly that's what we call estate pegging, estate duty pegging. From a tax perspective, yes, you can tax plan and make sure that that property, whatever income it's producing on a year-to-year basis, and if you have, for example, let's say 5 children and the husband and the wife, and you could take in total 7 beneficiaries. But what you can then do, whatever is the net income, remember I said it's a commercial property, you've rented it out, even if it's residential, you still rent it out. You'll be getting rental income after expenses, whatever that income is. Let's say, for argument's sake, it was 1 million rand for the year. You can then take that 1 million rand and then split it between your 5 beneficiaries, your 5 children that you have, who could be, as I said, 1 day old. It could be another child 1 year old, the other one 5-year-old, the other one 15-year-old, the other one 18-year-old. You could split that million rand, which means each one will get an equal share, which is 200,000 rand. Now at 200,000 rand, they become taxpayers again, provided the circumstances permit. And this is where SARS sees this as a red flag, or rather they see this as red. They just love to change this law to stop you using the conduit by principle to distribute income to beneficiaries, where these beneficiaries become taxpayers. And that's why they're making it very difficult for you to actually do that. But that's typically tax planning, splitting of income to pay the least amount of tax. You can also use a trust to protect your assets. That means that if you're a professional person or if you're in your business, and for some reason you sign surety, then remember, whatever assets, this 10 million rand asset that you've put into the trust, the creditor, even if you sign surety in your personal capacity, and you're a beneficiary of the trust, they can't come after you for the assets that are lying in the trust. So most definitely, assets that are in a trust where you are one of the beneficiaries together with your spouse and children, they can't come for any of those assets. So enjoy asset protection. It also creates succession planning. This is what wealthy people do. They have a trust. It carries on for generations. It goes from one generation to the next one and down to the third one and down to the fourth one. In South Africa, we have 5th and 6th level generation trusts that are running and effectively saving millions of rands in the form of taxes. So succession planning can be achieved. If you have minor children, then remember you can't pass assets over to them in any form. You would have to use a trust, and that's where a trust becomes pretty useful, where any kind of benefits you want to pass on to your minor children, you would do it via the trust. Also, you would achieve continuity and perpetuity going forward. Whatever assets in the trust, you don't in any way mention that in your will. Clearly, it runs on its own. It's got its own set of rules. It has a trust deed, and it runs on its own. And lastly, there's certainly a cost saving upon your death, because remember, the assets in the trust is not yours. So when you die, there's no capital gains tax to pay on those assets because they stay in the trust. There's no transfer duty. because it remains in the trust. There's no executor's fees that are payable had that particular property been in your name. However, having outlined all the benefits, there are certain distinct disadvantages of trust. And therefore, I think it's important you seek proper professional advice before you go into a trust. So what has happened, SARS have become very clever. They've decided to change the law in 2017, where they want to try and put the brakes on people who are using trusts to avoid taxes, whether it's estate duty, whether it's capital gains tax, whether it's income tax. What they are doing, they've introduced this law where if you give a loan to a trust to buy a property, and that property grows in value, that is why we always recommend anything that's going to grow in value, you put in the trust. Don't put a motor vehicle in a trust. A motor vehicle never grows in value. It's ridiculous for somebody to come to me and say, I'm buying this Porsche, it's worth 6 million rand, I want to put it into my trust. When you drive it out, it's lost 30% of its value the minute you drive it out of the showroom. So don't talk about putting things that are going to depreciate in value in a trust. Anything that's going to appreciate in value, yes, must go into the trust. So what SARS have done, they're saying that if you lend money or to the trust, for the trust to go and buy the asset, then we understand the assets are growing over the years. We can't do anything about the growth. However, the loan that you've made, we want you to pay tax on that loan that you've made. So what they're doing, they're applying what we call a special interest rate against the loan and redeeming that amount to be a donation. But as I indicated, there are many ways to skin a cat. So there are ways to circumvent Section 7C, which they've introduced from the tax year, the 28th of February 2018. So you can rearrange those loans, repay the loans, make donations. It's all about planning and, again, getting the best tax advice. So you need to go to the right people who've got a good fiduciary background from a practice point of view and from a tax point of view as well, can give you good advice from that point of view. As far as your will and your estates are concerned, you have to have a properly structured will to make sure that your estate runs smoothly. That is very important. So when you draw up your will, you have to make sure that you have a will, so you pave a way. But if you don't have a will, then there's no way for your family to move forward. So certainly from a will perspective, we have to follow the Wills Act and what we call the law of succession. So when we look at when a person dies, what we look at is a copy of his will. So either he has a will or he has no will. So if he has a will, it's important that the will be a valid will. So a valid will has to follow the provisions of the Wills Act. And that is a pretty rigid way of structuring your will. So you have to follow all of those clauses that, in other words, you have to have a proper signature. It must be witnessed by two competent witnesses. If those are not there, then it is not a valid will, and then you have a problem. So if you do have a valid will, your estate will devolve as per your instructions. So the instructions are your instructions. You decide how you want your assets to be bequeathed, and that's entirely left up to you. But on the other hand, if you don't have a will, or if you don't have a valid will because you follow the provisions of the Wills Act, then clearly you'll have to follow the laws of interstate succession, and these are pretty rigid, inflexible, not the best thing under the sun. And you'll find that people will benefit from your assets whom you didn't really want them to benefit. People will be appointed to wind up your estates who shouldn't be winding up your estates, etc. So you don't want to go down that road. So make sure that you have a proper structured will. So makes you think, doesn't it? Do you have a will? Is it valid in terms of the Wills Act? Have you been updating your will? Ideally, you need to do that at least once a year, or when your circumstances change during the year. You could have a death, could have a birth, could get married, could get divorced. So all of those things count. Also, having an updated will is important because if you did a will and if you die, and then that will you did 25 years ago, you probably nominated your children and they are no longer around. They perhaps in Australia or in New Zealand or the UK, wherever they are, and they're not interested in collecting any of the assets that are in South Africa. So you can see how important it is to make sure that your will is updated at all times. Also, the will needs to be personalized. You as a high net worth individual, you have assets. The first thing you do is make a list of all your assets and make sure you bequeath these assets based on the laws that you see. Now, certainly, there are lots of provisions in the law, and again, it goes back to planning, that you organize your things in a way that you're going to pay the least amount of estate duty, pay the least amount of income tax. I'm going to come back to these, and capital gains tax. I'm going to come back to these points just now. But the will has to be personalized. You can't have a standard will. A lot of these institutions can put you into a position where you drop a very standard will. Don't go for those standard wills. It must be personalized. You need to see somebody on a one-on-one basis, not just go to a counter where you just meet one person, make you just sign the will, they file it away, you don't even know anything further about it. And only when somebody dies, you suddenly realize that you have the first page and it's a photocopy and you have to contact the institution. Don't go for those kind of wills. Okay, so when we're looking at administering your estate, there are lots of things that you have to consider when that is done. And generally, estates get procrastinated, they get delayed, they carry on for a very long time. So how long does it really take to wind up an estate? So how long is a piece of string? Can it take months? Could it take years, perhaps? Could it be decades? Will it never get done? But why? Because you don't have a valid will. Maybe there are missing documents. People can't find their IDs. Your marriage certificate is lost. Your spouse takes 1 year to even try and find it. All the title deeds are not in one place. You've lost some of them. Now you're going to have to apply for them. Your financial information is not up to date. Your financial statements in your practice, or for that matter in your business, have not been drawn for the last 5 years. Your tax returns have not been completed. And you have outstandings. You have a complicated business interest, but there's no estate planning. You have cash shortfalls to cover liabilities and expenses. And this creates a serious problem because if there are cash shortfalls and if the liabilities are not paid, then all those assets that are in your estate will never reach your beneficiaries because you have to wind up the estate. And the first thing you have to do is pay all your liabilities as well as pay any expenses of the estate. And that can't be paid. And based on the fact that you cannot pay it, you're going to find that you will certainly have an issue. So I think that that's something that you look at very carefully. There are provisions in the law, for example, Section 4Q of the Estate Duty Act, which allows you to roll over your entire estate to your surviving spouse. And by doing that, clearly there won't be any estate duty payable upon the first dying spouse. But it's important that you get basically a financial planner, an estate planner, and a tax consultant to advise you as far as this is concerned. I'm just going to go on pretty quickly now. It's important for you to understand that you create wealth over generations. Paying taxes is a harsh reality. You should consider the following: that your assets get structured in the appropriate entity, that your tax affairs are in order. Do you have a properly managed family trust? Do you have a properly structured will? Are your beneficiaries properly stated in your insurance and investment policies? You can't nominate minors because then the money goes into the guardian fund. Does the will, the family trust, the insurance policies, and the personal assets tie up? These are important considerations. Strategic wealth management, how you manage your wealth strategically. Now, if you're a medical doctor, you ask your patient to see you once a year. It's a profile that you apply. You look at his blood sugar, the blood pressure, you look at the cholesterol, you do his ECG, and if all is normal, you give him a clean bill of health. Now, I'd like to ask you, as a doctor, or for that matter, a businessman, or whoever you are, how often do you go for a financial checkup to a financial planner to check on your risk cover, to make sure that if you die untimely, that there's sufficient capital that gets invested so your family can enjoy the same lifestyle that you enjoy, that you've created wealth for your retirement, that your tax affairs are in order, that you have an interview of trust and is all operational and up to date, that you have a will. Therefore, it's important for you to talk to a financial planner and you do a financial needs analysis. It's important for you to consider investing offshore purely on the basis that you have to diversify your risk because, South Africa is high risk. Also, the rand, the way it's depreciating, it was used when we first had democracy, it was 325. It's now sitting at 18 rand. can see it's getting weaker by the year. And despite the fact that South Africa is one of the largest mineral resource countries in the world, but we're getting nowhere in this country. Geopolitical risk, we know the politics in this country. There's two ways of investing offshore. You could either go onshore, go to a financial institution, let them take it offshore, or you could change your money into pounds and dollars or euros and then invest it offshore. The investment limits that will apply for the onshore offshore, there's no limits, but for offshore, it's 10 million rand per year per taxpayer. It's pretty lenient. There's a lot available. You can speak to our office or anybody else. They will tell you you can get a unique capital guaranteed product offshore where you can benefit substantially. PPS is a good thing. Professionals, I'm not going to go into the slide, but this is the first door that you should be knocking at to make sure that you consider, because they have a profit share account, which you could benefit at the end tax-free. Financial Action Task Force has introduced this new laws in South Africa, and whether it's the Financial Intelligence Center Act or the Non-Profit Organization Act, Financial Sector Regulation Act, the Trust Property Control Act, the Companies Act, all of these acts are basically saying you cannot have nominees anymore. You have to be the front of whatever you're doing for money laundering purposes. So clearly, you have to be very careful of these provisions, especially the Trust Property Control Act and the Companies Act. You cannot hide behind anything anymore. Managing your practice, I'm not going to look at this, but by and large, you have to have, you may be a medical doctor, you've done well, but you have to have good management skills. And this particular slide shows you the different aspects that you need to consider.
You're just too good to be true. Can't take my eyes off of you. You'd be like heaven to touch. I wanna hold you so much. At long last, love has arrived, and I thank God I'm alive. You're just too good to be true. Can't take my eyes off you. Pardon the way that I stare. There's nothing.
Well, I did tell you that SARS is a partner in your business. They'll never forget you. They'll always be after you. They'll come for you. Well, I just want to conclude by saying we are a multidisciplinary firm. We have CAs, we have lawyers, we have certified financial planners who basically look at your insurance and investments. We have tax practitioners. We have business rescue practitioners. All of these professionals in one team, under one roof, in one firm. And we provide services from tax to accounting, to business advisory, to insurance, to investments, to wills, to trust, to deceased estate, to business rescue. We have offices in Durban and in Johannesburg. There's our email address, info@garach.co.za. Please feel free to contact us. We certainly can be of help to you. Thank you. And if there are any questions, I'm happy to answer any questions that you may have. Can we field any questions?
If you don't have any questions immediately, if you would like to then type your questions into the chat, we can always pass it on to Prof. Garach. In the interim, I would also like to call upon Mina Mystery. Mina, would you like to unmute yourself and say a few words for us before we end this webinar?
Thank you, Prof, for attending today and giving us your precious time. Thank you, Rosh and Koshambi, for setting this up. It's always nice to get a financial talk at the beginning of 2024 as a way of learning all the different things in saving tax, and it was very, very beneficial. If you want to have a personal consult with Prof, he has left his details. Please do contact him personally, Garach and Garach. They're based in Joburg and in Durban. Thank you once again. Have a good evening and enjoy the rest of the soccer. I hope Bafana wins. Thank you.
Thank you for that, Mina. Prof, I don't know if you want to just say anything in closing. Otherwise, we will close the session now. But just from myself, just a reminder to all those that are the medical professions, please remember it is important that you complete the feedback form, because that's mandatory for us to send your number in for capture for the CPD point. And then obviously there is a cost of 150 Rand for that as well.
Thank you, Roshni, for giving me the opportunity, and Mina and Shiv Dev for giving me this opportunity to talk to the participants, and I hope they enjoyed it. But they're most free to call me and chat to me if they have any personal issues. Thank you.
Thank you, Prof. And then with that, we will say goodbye to all our delegates. For all of them that have signed in, please note that this is also going to be available on YouTube. So if you've got colleagues that would like to watch it later, they can do it. There is a link for the feedback form on YouTube. They can pay their fees, they can complete the YouTube, and they will also receive their points. Have a good evening further. And as Mina said, hopefully Bafana's still playing. You might be able to catch the last bit of the game. Thank you. Goodbye.
Everybody.